Hi everyone and welcome to the channel. Today we're going to talk about 5 behavioral traits that derail your investment. But before jumping into the topic, press the subscribe button down below, the thumb up and the bell to remain updated with our latest contents. And now let's jump into it. The psychology of investors is a pivotal yet often overlooked aspect for financial success. While we are all used to the mantra buy it low and sell it high, it is the hidden forces behind human behavior that truly shape our journey as investors. As Daniel Kahneman, one of the fathers of behavioral finance, once said, financial decision making, as we observe in the world, is a far cry from the rational process as described in the textbook. And I am totally in line with this stance. Behavioral traits and cognitive biases try to sabotage our investment strategies, and that's clear, undermining our ability to build up wealth and achieve our financial goals. And the reason is simple. First of all, they blur our rationality, they cloud our judgment, and often compel to act against our best interest. But now let's delve into the 5 most vicious behavioral traits that frequently tend to derail our investments. Number 1. Confirmation bias. That is our tendency to seek information that in a way or another align with our previous beliefs. We would like in substance to hear what we like. And this blinds us to alternative perspectives and prevents us to make a well-informed decision. This aspect is particularly typical and particularly evident in a political context, isn't it? Number 2. Gambler's Fallacy, often called Monte Carlo Fallacy. This specific psychological bias gives us a distorted understanding of probability, leading us to erroneously assume that the past will repeat. But this is not always the case. It also gives us the perception that the past outcomes will influence in a way or another whatever will come next. A simple example, at the roulette table, if we will assist to a streak of a specific color, we will either tend to believe that the series will continue or that a change in the outcome will arrive soon, ignoring the probability that the ball falling on the black rather than on the red are exactly the same, 50-50. Number 3. Probability neglect. As for Monte Carlo fallacy, in our journey to financial independence, we often overlook the statistic probabilities, notably associated with our investment decision, leading us to take unnecessary risk and fall victim of speculative bubbles. For instance, we can tend to get fooled by unrealistic gains, even if highly unlikely, exactly as it works for the lotteries. We ultimately prefer the possible over the probable. Speaking in concrete terms, people tend to buy in more and more of the winning stocks, pretending that the positive trend will continue forever, until they have a reality check and they are caught in a market crash. It happened. Number 4. Herd bias. The herd mentality exerts a powerful influence on our behavior, compelling us to follow the crowd, even when it contradicts our better judgment. Follow the trend. Does it sound familiar? I tend to define myself as a contrarian investor. So if the investor base follow one route, I take the opposite. Let's move on. Number 5. Anchoring effect. That to me is the most powerful bias among all. It refers to our tendency to anchor our decision according to previous information that can blind us to new opportunities and prevents us to adapt according to the current market conditions, hindering our abilities to achieve optimal investment outcomes. Long story short, our brains takes as valid the first piece of information that we come across, and according to this anchor adjusts our perception of reality. Picture this. Let's say you are considering buying a stock, and the price for a share is $100. You run your analysis, maybe using fundamental analysis, and you discover that the fair value is $80. At the same time, you remember that a few years ago, the price of the very same stock was $150. Ultimately, you decide to buy the stock because you have the perception that the price is currently trading at discount. $100 versus $150 as noted in the past. The anchoring bias can lead you to make decisions that are not aligned with reality, and for sure not in line with rational analysis, resulting into suboptimal outcomes. Okay, but now you may ask, how do I put all this kind of information in practice in order to have a positive return on the market? Well, to make things simple, let's touch 3 main concepts that are deeply interlinked one another. The first one refers to the terms underreaction. The second one is overreaction. And the third one is the mean reversion. And the reaction occurs whenever the news are not fully reflected in the prices, leading to gradual adjustments. And this can definitely create opportunities for savvy investors to profit from mispriced assets. And this is a plus. A quick example, we have a stellar earning report, but the price doesn't move. On the flip side, overreaction happens when recent events drive exaggerated price movements. This creates market inefficiencies that contrary investors can exploit for profit. The understanding of these 2 concepts is key for navigating market volatility and finding investment opportunities. Both under and overreaction to information lead to mean reversion, that is the tendency of the prices to revert to the long-term historical price after experiencing periods of excessive heights and lows. This is the most evident manifestation of behavioral biases. And this is up to you whether to succumb or take profit out of it, underscoring the importance of discipline and patience in investing, as it suggests that assets that perform exceptionally well or exceptionally badly will correct in the medium term to more typical levels in the future. Anyhow, just to quote Charlie Munger, imitating the herd invites regression to the mean. And that's undisputable. From a personal perspective, understanding the mechanics behind the mean reversion can help investors in order to avoid the traps of chasing past performance, and instead grants us the ability to focus on more sustainable long-term value. Anyway, each and every investor has his own winning strategy, so feel free to make your experiences and pick yours with an adequate dose of prudence, I would say. In essence, navigating the investor psychology requires a blend of self-awareness, discipline, and rationality. So to cultivate a more prudent and resilient approach towards investing. And remember that the journey to financial success it is not just about avoiding mistakes, but embracing them as valuable learning experiences on the path to achieving our long-term financial goals. So guys, we reached the end of the video. We'd like to thank you really a lot for staying with me until this point, but before leaving us, press the subscribe button down below, the thumb up, the bell, and share the content with your friends. Cheers, see you in the next one.